While I have your undivided attention, I'm going to put a plug in for keeping our businesses open. I hope everyone is using their face masks and keeping social distance. We we have opened up our businesses and our economy, and we're slowly crawling back. Let's not go backwards. So please make sure that all of us are protecting one another as well as each other's jobs by wearing your mask. So we all appreciate the Chamber is very, very supportive of those initiatives. And let's go ahead and get started. This is Alfred Sanchez. I'm the CEO of the Greater Miami Chamber. I want to welcome you to our Thursday Roundtable. As you know, every Thursday we've been having incredible topics. Today we'll be talking about Main Street Lending Program, one of the most talked about latest programs following the PPP from the feds. So we're excited to learn about that. Today's program is brought to you by our Chamber Banking and Finance Committee, led by Gladys Reed and Lucy Nunez, who are joining us here today. And it's sponsored by MBAF, Certified Public Accountants and Advisors. And we want to really send a special thanks to MBAF, who has been just incredible supporters throughout the many years. The Chamber has taken a very active role in helping small businesses with their loan and application forgiveness programs. Through our help desk that we call GMCC Cares. I can ask the staff to maybe drop in the GMCC Cares link in the chat. It's an important program for any one of our small businesses who are looking for direct assistance. So let us know, either with the application or with the forgiveness portion. We also have partnered with Career for South Florida. That in a program that is really called and purpose for layoff aversion. We're processing up to $500,000 in small business grants to allow for reimbursements of those expenses that you may have had in keeping your business open by complying with COVID-19 prevention, sanitation efforts. I'll ask the staff if they can also put a link to that program as well. The reimbursements are up to $10,000. I'm going to drop in a second after I finish speaking. I'll drop in the requirements. But one thing that I want you to know, it's for small businesses, 3 to 50 employees, and in Miami-Dade County. The key thing is it's for reimbursement. So it's expenses you've already made in supplies, et cetera, that really help you to keep your business open and keep your workers employed. So I'll drop all those requirements in there, but visit the link that's being given to you by our staff. So today's lending program will cover a lot about the new lending program. And so I'm excited to hear more about that and how all the small businesses and nonprofits can access it. Before I turn it over to Gladys Reed, I want to just run through some of the logistics as we usually do in this program. We really want to have time for your questions. Everyone's microphones are muted. Please use the chat for comments and to exchange ideas and share with one another. And of course, you know, networking is part of the Chamber's DNA, so use the chat for that. We've left it open. The Q&A feature is where you want to put your questions. So if you want to address a question to the panelists, please type your question in there, because only those will be used and floated up to our panelists by our staff. This webinar is being recorded, and we'll make it available to you later on the Chamber website, okay? So with that, it's my pleasure to introduce the chair of the Greater Miami Chamber of Commerce, Banking and Finance Committee, Gladys Reed, a great friend of mine. Gladys is Senior Vice President for Ocean Bank Wealth Management Department. She oversees the bank's Private Client Service Division, and she's a longtime banking professional and a tremendous member of this chamber. She's also extremely civically active in the United Way, Habitat for Humanities, and many other things, many other organizations. So with that, my friend Gladys, I'm going to turn it over to you.
Thank you, Alfred. Thank you for everything you and the chamber are doing. I mean, I think all these webinars and all these programs are just great. I want to start by giving a little bit of a shout out to the Banking and Finance Committee. We've been very active, very proud of everything we've accomplished this year. We've covered a lot of great content, everything from the cannabis industry to the Census 2020, doing the economic summit. We've had great speakers like Kimberly Reed, no relation, so I'd love to be related to her. Chairman and President of the Export and Import Bank of the USA. We've had Alex Sanchez early on, President and CEO of the Florida Bankers Association, to talk about the PPP lending program. So a lot that we've covered, too much to go over all this time. But again, I'm very proud of our committee, and a quick shout out to Lucy Nunez, our co-chair from Pacific National Bank. And you'll hear her a little bit later on today, but Irby Blanco True, who is our chair of the industry growth industry, which is part of the banking and committee. Thank you so much for your continuous support and effort. And of course, Stephanie and Tanya. None of this can be accomplished without great sponsors. So I have to thank as well our presenting sponsor, Morrison Brown Agis Farah. MBAF is ranked nationally as a top 40 accounting and advisory firm and has been named one of the best firms in the country by the Inside Public Accounting for many years running. They have over 600 principals and employees that serve domestic and international clients. And of course, as Alfred said, they are so supportive of the Chamber and so many organizations. Thank you so much, MBAF, for supporting us in everything you do for our community. I also want to encourage everyone to use the chat box for the comments. We want to hear from you. We want to hear your ideas and your questions. We want to try to get to them as much as possible. Now I want to go over our great, the three panelists. I want to thank them so much for their time and for their expertise today. I want to start with Jordan Argis, CPA. By the way, we have their full bios, but I'm just going to kind of do top level. Jordan Argis, CPA, is a director in the audit department and the risk and transaction advisory practice at MBAF. Since 2012, Jordan has been providing assurance and consulting services to companies in various industries with a focused experience in automotive dealerships, professional sports team and stadium facilities, real estate, technology, wholesale distribution, and others. Thank you so much, Jordan, for joining us today. Then Samira Fasili is the Director of Engagement for the Federal Reserve Bank of Atlanta's Community and Economic Development Department. She has spent her career working in domestic and international economic development with a focus on access to finance and social enterprise. Thank you so much, Samira, for joining us today. Then Derek Yanis is Credit Manager and Senior VP at Pacific National Bank. He's a 20-year banking veteran with the last 10 years focused in credit and lending divisions. Thank you so much as well, Derek. So, we're going to get a great viewpoint from the accounting side, from the Federal Reserve side, and on the banking side. So this is going to, I know, be a great presentation today. And then I want to thank and introduce my good friend, Irby Blanco True. Irby has over 30 years of experience in banking. I read that. Is that true? She must have started at 5. We'll stick to that line. But anyway, she currently serves as a CRA advisor to Iberia Bank, where she specializes in all areas of the Community Reinvestment Act. She's been very involved in many boards and communities. Again, we would spend all day if I mentioned all of them. But she does a lot for our community, and we thank her for that. And she's our current chair of the Industry Growth Group Committee. That's a mouthful. So with that, Irby, I'm going to hand it over to you.
Thank you, Gladys. Welcome, everyone, and thank you for participating in today's webinar. I'd like to start off with our good friend Samira from the Federal Reserve Bank. She's going to give us an overview of the Main Street Lending Program. You're on, Samira. Thank you.
All right. Thank you, Irby. Thank you to the Chamber for having me here today. I'm actually Atlanta, but I think many of you are familiar with our Miami office, our Miami branch that is led by Karen Gilmore and her team there that does a lot of work supporting our monetary policy work. From our research division, where I study community economic development issues, including small business lending. So I'll kick us off by giving some really basic information about the Main Street Lending Program. I think most of us here are familiar with the fact that most small businesses don't have the financial cushion to hold up for long with reduced revenue or no revenue, which is a situation many of them faced with government mandated stay-at-home orders and public health guidance for the public to observe social distancing. And even though they might be tiny, we also know these firms are important in the overall economy. According to the Small Business Administration, they're responsible for 2 out of every 3 new jobs and employ nearly 50% of private sector workers. So it's critical to the health of the overall US economy that we avoid having large numbers of otherwise healthy firms close permanently. And that's why the Federal Reserve stepped in to try to support the flow of credit to small businesses by creating the Main Street Lending Program. The program is designed to help credit flow to small and medium-sized businesses, and we even have a kind of window for nonprofits as well. And it's focused on those that were in solid financial shape before the COVID-19 crisis hit and need loans to help stay afloat until they recover from or adapt to the effects of the pandemic. We know that the program is not meant for all companies. It was set up for companies that generally are too big for the Paycheck Protection Program that SBA had stood up, but probably too small for the other credit facilities that the Fed stood up in March to help stabilize financial markets. And this was designed to be loans, not grants. So it has to also be firms that are in a position to take on loans. In the Main Street program, the Fed is not issuing loans directly to small businesses. Instead, we are trying to support lenders' ability to make loans available to small businesses. If you could put the slide up that I submitted. The details I'm about to share are available on the Boston Fed's website and the Board of Governors website. So I included these 2 links here for you. And if someone from the staff wants to add them to the chat, that would be great too. Both of them are going to give you, really thorough FAQs and all the basic program documents. And so here are some of the really basic requirements that borrowers must meet. You can pull the slide down whenever you guys want, and thank people have recorded the website. A company must have been established before March 13th of this year, and either have 15,000 or fewer employees or 2019 revenues of $5 billion or less to apply for the loan. There are 3 different loans that the borrower can apply for if they meet that criteria. We have something called the New Loan Facility, another one called the Priority Loan Facility, and then the Expanded Loan Facility. Each is designed to address slightly different types of borrowers with slightly different credit needs, but a company can only borrow from one of the programs at a time. Across all 3 programs, you're going to get a few terms in common. You're going to get a 5-year loan. It's going to require no principal payments for 2 years and no interest payments for a year. And the interest rates are going to be an adjustable rate of LIBOR plus 3%. And that's based on 1 or 3-month LIBOR. The key difference between the loans include the minimum and maximum loan size and how leveraged a business can be. So the Main Street New Loan Facility has a minimum loan size of $250,000 and a maximum of $35 million. The borrower's total loan size cannot lead the borrower's total debt to ultimately be more than 4 times EBITDA. So 4 times the company's 2019 earnings before interest, taxes, depreciation, and amortization. For firms that need slightly larger loan amounts, we have the Main Street Priority Loan Facility. So there you'll get a maximum loan of $50 million, or an amount that doesn't push the borrower's debt over 6 times 2019 earnings. The Priority Loan Fund also has some unique provisions in there about refinancing other debt. And I think my co-panelists are going to dig in a little bit deeper into those kind of terms. And then finally, there's the Expanded Loan Facility. This allows lenders to increase the size of an existing loan the borrower has with the bank. The original loan must have been originated on or before April 24th, 2020, and have a remaining maturity of at least 18 months. The minimum loan size for the Expanded Loan Facility is $10 million, and the maximum is $300 million, or an amount that's not going to push the borrower's total debt over 6 times EBITDA. So this product is designed for borrowers with larger and more complex kind of existing loans. Before I close, I'm going to repeat something I said at the start. If you want these loans, you can't come to the Atlanta Fed to ask for one. We are not a direct lender to businesses. To start the process of applying for one of these loans, you must find a financial institution that has agreed to offer them. The institutions that can sign up to be lenders include things like U.S. federally insured depository institutions like banks, saving associations, credit unions. And if you can put that slide up again, you can go to those websites, and the Boston website in particular, to find a list of eligible lenders. And right now, we don't have non-bank financial institutions are not eligible for the Main Street program, but we still continue to consider if we're going to be able to do that one day. To help make it easier to find lenders, the Boston Fed's website also includes a state-by-state roster of Main Street lenders, of lenders who signed up for the program, who said they were willing to possibly take new customers. That's important because we know a lot of small businesses, especially minority-owned ones, don't always have relationships with banks or credit relationships with banks. That when you go to that website and check out the lender map, know that it's not necessarily an all-inclusive list of banks in the program. It was just banks who opted to be shown on that website. And I know that there are about a dozen, maybe a little bit over a dozen Florida institutions on that map right now. So in conclusion, if you're interested in borrowing through Main Street, look at these websites I just mentioned, contact an eligible lender for more information on the application process. Ultimately, it's the lender who's going to decide whether you're approved for the loan, and the lender is allowed to set their own underwriting standards and criteria. The program closes on September 30th and is up and running today. So with that, I'll turn it back to you, Irby.
Thank you, Samira. And that's a good segue to our banker on the panel, which is Derek Yanis. Derek, make sure that you unmute yourself. We'd love for you to give us a little overview from the banker's perspective and maybe give us some real world examples. I do want to say that there are some questions in the Q&A and we will try to get to those at the end, but we're going to start with just an overview from each one of our panelists first. So thank you for the questions. Keep them coming.
Okay, great. Thank you, Irby. And I want to first thank the Chamber, the sponsors, moderators for putting this together, as well as the attendees for joining. I know there's a lot of questions that surround this program and how it affects some. So I hope to cover some of that territory today. I'm going to go over three hot topics that I think are of use to the attendees here. First, I'm going to cover misconceptions with the program. I'm going to run through a hypothetical scenario so that I can kind of help you gauge where it might fit. And I'll go through a list of places to start the process, okay? So leading off with the misconceptions, PNB has received an abundance of these requests since we've been out as a registered lender under the program. And the first misconception I find with a lot of inquiries is they're drawing parallels to the PPP program. And as Samira mentioned, PPP was one program and this is another. So from a risk perspective on the lending side, the MSLP operates in its functionality similar to a traditional commercial lending product. So under the PPP, there was the forgiveness component, and then there was also the 100% SBA guarantee. In this case, the functionality is indicative of that of a loan participation, whereby the lender will retain a 5% interest in the loan and 95% will be sold to the Fed. And the repayment of the loan cannot be forgiven. It will not be extinguished. It will not. So in weighing this out from the lending perspective, the bank will weigh the risks appropriately as it would under its traditional underwriting standards. The second and most important misconception is that some inquiring businesses feel like that any one lender may be obligated to lend under the program so long as they've met the 4 times or 6 times EBITDA requirement in order to size a loan. And as Samira mentioned, though, that that from a lending institution perspective, that any one loan inquiry would have to fit within however they've specified their participation program it is. And one thing that's important to note is that each one of these loan requests, it becomes incumbent on the lender to determine the duration of the pandemic's impact on any business or industry. So that will weigh in the ultimate decision in the long run. Also, any one particular lender may draw some borders in how they lend, maximum size, geographical boundaries, max leverage, requirement of collateral, and so on and so forth. So based on that, it's going to vary from lender to lender. So don't limit yourself to any one lender in particular. Moving on to the hypothetical situation, I'm going to just focus on the new and priority facilities, as that's going to cast the broadest net for these loan types. The expanded facility starts at $10 million, and that program is limited to working with your existing lender to upsize your existing loan. So I'm just going to leave that on the side for now. So for simplicity's sake, I'm going to just kind of keep this on the low end of the spectrum and use a hypothetical $250,000 loan, which is on the lowest end of the scale here. And I'm just going to use consistent assumptions that this is an eligible business with no existing debt, okay? So if any one business is going to inquire about a $250,000 loan, what does that mean? Well, your earnings before interest, taxes, and depreciation cannot exceed 4 times of the requested amount. So at $250,000 loan request at the 4 multiple of EBITDA, a eligible business would have to show around $62,500 in EBITDA. Given that, I'm going to run through each year of the loan and how this affects the business. This is a 5-year term loan with different payment streams over each one of the years. The program allows for 12 months, the initial 12 months of a loan with deferred interest and principal for year 1. However, that comes with a caveat. The proverbial meter is running during that first 12 months. Essentially, the interest, although not required to be paid, is accruing during that time and will be capitalized in conjunction with the bank's standard deferred interest program. So for our scenario, I'm going to use the assumption that the deferred interest will be capitalized at the expiration of year 1. So in year 1, no payments are to be made. However, at the end of year 1, around $8,250 will have accrued during that period of time. That amount will be added on to your loan. So although you've borrowed $250,000, you now technically owe $258,250. Commencing in year 2, this period is your interest-only loan terms, right? So you commence with monthly payments of approximately $700, which just covers your interest. And your loan balance will not swell beyond that period of time. Year 3 is when things dramatically change. You will continue with your $700 monthly interest payments. However, at the expiration of this term, you will have to make a 15% principal curtailment or principal reduction, which in this case, using $250,000 in our scenario, which would be about $40,000. So collectively, over the term of year 3, your business, assuming that you did not deviate or you're able to recover your earnings at $62,500, your total all-in interest carry plus principal curtailment is the $40,000 plus $700,000 per month, which equates to roughly 77% of those earnings. One situation which a borrower should really look at is that, if you are unable to grow top line revenue or control operating expenses, that this may be a bit of a burden for repayment. Year 4 operates similarly in the sense that you're paying monthly interest-only payments, and at the end of year 4, another 15% is due. So in this case, your payments, you do get some payment relief from interest in the sense that the principal has been reduced and therefore your monthly payment is reduced based on your interest-only payments. And the principal curtailment at the end is also reduced because of the lower amount. In this case, it's $600 a month and $32,000 principal curtailment. There is some relief as the relative percentage of earnings, which would equate to about 62%, but the same challenges in growing top line revenue and controlling operating expenses exist. Year 5 is probably the greatest degree of risk across the board here. The full loan will become due and payable at the end. So it's only 30% of the principal will have been repaid in years 3 and 4. In this scenario, you get the same payment relief on a monthly basis. Your monthly payments would reduce to about $500 a month. However, at the end of the period, there would be about $187,000 due, which represents a multiple of earnings before that time. So without appropriately budgeting and whatnot, this could be relatively burdensome for any one particular borrower. In this case, this represents an inflection point for some lenders here, as the full loan would come due and payable, and most lenders' stances in this circumstance would be to extend or renew the loan. So from that perspective, the Fed as participant holding 95% in any one particular loan, the bank would have to take a consideration with its exposure at around $9,300 to increase it up to $187,000 and renew the loan facility in the event that the Fed does not wish to continue as participant in the transaction. Under the priority facility, the repayment terms and everything that I just discussed remain the same. However, as this loan is sized to a multiple of 6 EBITDA, this is representative of a minimum EBITDA for any one particular borrower of $42,000 per year. So in comparing the two, we're looking at $42,000 versus $62,000 per year. So you can see that this particular business in this scenario would be stretched a little bit more thin. All things being equal, the percentage overall of what earnings were relative to the amount of repayment any one particular borrower may find this additionally burdensome. So a couple takeaways here is that if any one borrower is looking to at either one of these programs, you need to take a look at how these repayment schedules work and how that fits into how your next couple years will look and how you're projecting that out. The 4 to 6 times EBITDA here are loan sizing requirements, but they are not definitive. So just because you qualify at 4 to 6 times doesn't mean that your loan size has to be at those amounts. You can actually do it lower on the spectrum of total leverage and then kind of reduce some of the burden overall. And one of the key features of the program is that there are no prohibitions against prepayments, such as like prepayment penalties or anything along those lines, so that you can actually make principal reductions over time to kind of lessen that burden in years 3 through 5. Okay. So where does any one particular borrower get started? All right, so I'm going to kind of give you about 6 or 7 steps in how you can get your documentation in order and approach any one of the registered lenders under the Main Street program. The first step is to look at the borrower certifications, which you can find on the links that were shared by Samira. This is the most important document, as it is the do's and don'ts and cans and can'ts under the program here. So you need to review these or share it with your own legal counsel, have them review it, make sure that everything works for you and that the document can be certified. If not, then this program may not be for you. There's other programs to explore out there. Next step would be to determine which program is for you. Are you under the new or are you under the priority? A couple things to keep in mind is that both of these programs could be secured or unsecured. So if you're going to explore one of those, you need to know then what your purpose is. If you are a business with no debt, I would recommend taking a look at the new program. If you are looking to refinance some of your existing debt, you're limited to the priority facility. There can be done under the expanded as well, but like I mentioned, that would have to be dealt with your existing lender, and the minimum loan size for that is 10 million. Next step is to gather financial information. Now this will vary from lender to lender, but I would recommend increasing the operational time horizon in which you are looking to provide any one lender under this program. So a minimum of 3 to 5 years should be provided. Tax returns, CPA compiled statements reviewed or audited may vary from lender to lender, and in the higher the quality, the better, I would say. But that's an inquiry that you would need to make. If you're going to offer personal guarantees in the program, which again would be may or may not be a lender requirement, personal financial statements for any of the individuals that is current and up to date, as well as 3 years personal tax returns should be supplied to the lender. Next step would be to determine what collateral is available. Are there any existing debt out there? How is that secured? Do you have assets to pledge? Is there real estate, equipment, inventory, accounts receivable, anything along those lines? What's free and what are you willing to offer under the program? Next up would be like if you have financial projections for the next 3 to 5 years, that would assist the lender greatly in determining how impactful the years 3 through 5 would be on the business overall when determining the repayment of the loan. Next up would be to provide a good description of how the money that you're going to borrow will be used. Is it going to refinance debt? Is it going to be towards an acquisition, a strategic acquisition of another business? You know, just detail all of that so that you can provide an eligible lender with detail. And then the last step would be to identify certain lenders in your geography that are participating in the program, and find a lending institution similar to PNB that offers a full suite of commercial lending products, whether it be your traditional commercial, Main Street, PPP, or even full suite of SBA products. That way, if the Main Street isn't determined to be the best fit for you, that they can find the right lending program that may work best for your business. And then also don't limit yourself to one lender in particular. Terms, not terms necessarily, but interpretation of credit and risk will vary from lender to lender. So don't limit yourself to just one. So that's basically my part, Irby, and I want to thank everybody once again, and I'm looking forward to the Q&A.
Thank you, Derek. Next, I want to go ahead and go to Jordan, who is our representative on the accounting side. I'm not sure if the screen is being shared. So Jordan is with MBAF. Thank you for being our sponsor, and we'd love to get your perspective. I know you have a lot of clients that are interested in this program, and we'd love to get your perspective from the accountant side as to what you've been seeing.
Well, thank you, Irby, and thanks to the Chamber, the other panelists, and everyone that's joined us today. I'm going to be talking a little bit about eligibility in the program, like who can apply, who cannot apply, what certifications and restrictions are there under the Main Street program. So to be eligible under the Main Street program, a business must meet the following criteria. You have to have been established before March 13th, 2020. You must not be an ineligible business. And what that means is ineligible businesses, they reference the same usage that was under the PPP program, which the SBA has defined kind of a list that's been modified several times as to who is or is not, or who's not able to receive the Main Street loan. So you can reference the SBA's website and certifications on those. And the FAQs specifically call out ineligible businesses as private equity funds and certain portfolio companies of private equity funds. So the portfolio company of a private equity fund, their eligibility would be calculated by aggregating employees and revenues of all affiliated entities, which we'll get into what affiliates means in a minute. The business must also meet at least one of the following two conditions. One, have 15,000 employees or fewer. And two, have 2019 annual revenues of $5 billion or less. Again, you must meet one of the two conditions. You're not required to meet both. And to determine how many employees a business has or how much revenue a business has, the business must be aggregated with the employees and revenues of its affiliated entities. And, you know, just kind of a broad overview, because it gets pretty technical on affiliation rules. The broad affiliation rules are, again, the same as what was applied to the size test for the Paycheck Protection Program, which are used to determine affiliates for purposes of the Main Street program. So in general, if an entity has control, whether it's by ownership or just control rights, the right to control in and of itself is also control, then those entities would be deemed affiliated, and you'd kind of have to aggregate, the employees, number of employees and the revenues with yourself. The business must also be a U.S. business. So under the CARES Act, you have to be a business that was created or organized in the United States under the laws of the U.S. with significant operations in and a majority of your employees based in the U.S. So what does this mean? Significant operations in the United States means, again, evaluated on a consolidated basis. This is not with affiliates, but with your subsidiaries. So just companies that you own. So not necessarily your parent companies, but just if you own any other companies that are below you, you have to factor those in. And greater than 50% of that eligible borrower's assets have to be in the U.S. The income that they generate has to be US-based income, and net operating revenues or expenses in the US as well. So 50% is kind of the test for significant operations in the US. Businesses can only participate in one of the Main Street facilities, and you can't be participating in the primary market corporate credit facility, which is for larger companies generally. You cannot have received any specific support under Title IV of the CARES Act, which is specifically designated program money for passenger air carriers, cargo air carriers, and other businesses that are critical to supporting national and maintaining national security. Businesses that have received PPP loans and their affiliates are permitted to borrow under the Main Street Lending Program. I've seen some questions coming in about that. So if you have a PPP loan, you can still apply for the Main Street Lending Program. The businesses must also make certification and covenants, meet certain certification and covenants, which we'll go over. So to talk a little bit about these certifications and covenants, from a certification perspective, each loan has its own kind of set of criteria. There are about 18 pages per loan facility. So you have to, look into the specifics, but in general, you have to just certify that, the things we talked about above, you meet the definition of a business, you were established before March 13th, 2020. You're not an eligible business as the definitions for the SBA. You have either less than 15,000 employees or less than 5 billion in revenue. And you have to also certify that you won't go bankrupt within the next 90 days of applying for this loan. And kind of the last major thing here, and there's a little bit of ambiguity, it's not very clear, is you have to make a payroll certification saying that you'll make a commercially reasonable effort to retain employees during the term of the loan. So what does this mean? Well, we don't know exactly because that's all they say. It's not really like the PPP loan program where they gave exact provisions and calculations for retaining employees. It probably means you can't cut your workforce in half, during the time of getting the loan. But if you have made layoffs or furloughed employees, they do go out of their way to say that you can still apply for the loan if you've made cuts and furloughs. So the restrictions under the program. So there are a few restrictions if you borrow under this program. There's a limit on officer compensation or just overall employee compensation. And what they say is that you're limited to $425,000 in total compensation unless somebody made more than that in the previous year. So if you, in 2019, made anywhere between $425,000 and $3 million, you can't get a raise in 2020 and going forward during the term of the loan. And if you made over $3 million in 2019, you can't receive total compensation of more than $3 million plus 50% of the excess over that $3 million. So, you got to read carefully on these restrictions before you apply. There are, various. One of the other big ones is borrowers must agree that there's no stock buybacks or pay dividends. However, if you are an S corporation or a pass-through entity, you can make distributions to the extent required to cover the owner's tax obligations as it relates to that entity's earnings. And that exception was added in response to the feedback after the Fed put out the initial term sheet. Because again, people need to be able to cover their taxes. So from an allowable uses perspective, they don't really go into what you can use the money for. They do talk about what you can't. And, again, talking about you can't pay excess compensation, you can't pay dividends, you can't do stock buybacks. We've gotten some questions that, can somebody use the money for a capital acquisition or to acquire a business? And again, they don't explicitly say that you cannot do that. So until further guidance comes out, the restrictions are what are in there. Another point to talk about is unadjusted Ebitda. So if you look closely at the term sheet, it talks about getting your loan based on not just Ebitda, but an adjusted Ebitda. And what does that mean? Well, there's a lot of discretion involved and it can vary lender by lender. What they do say is the methodology that the lender applies should be consistent to what they're doing for other borrowers or similarly situated borrowers. So, you know, lender by lender, it depends is the answer, because sometimes they have additional adjustments for non-cash charges, extraordinary items. So you just have to look closely at the term sheet of your specific lender that you may go apply for. And as Derek mentioned, you know, you may want to kind of go to various lenders to see who may have more favorable terms. One other important thing to note is that the special purpose vehicle set up by the Main Street program has said that they will cease purchasing loan participations on September 30th. So unless the program's extended by the board and the Treasury Department, that's kind of the date. But there is a good chance, I think, that that date will be extended. If you're interested, you should probably still try and apply sooner rather than later. And that's really all I have. I mean, there are 80 pages of FAQs and there's a lot of detail on this. We could probably spend 4 hours. We're just trying to cover everything at a high level. We definitely want to get some time for Q&A. So Irby, I'll kick it back to you and we'll try to help address people's questions.
Great. Thank you for that overview, Jordan. Okay, let's go ahead and get to some of our participants' questions. So can a construction company apply for construction projects is one of the questions. I know Derek or Jordan, if you want to take that.
I can try to take that, and Derek, go ahead.
Yeah, go ahead. Okay, I was going to say that, and I'll let Jordan kind of fill in some of the blanks here though, but most construction loans are structured as like lines of credit where there are draw ups. From my read in the FAQs of the term sheets, this product is just indicative of a regular term loan. So from a construction perspective, you don't necessarily want the interest running on unborrowed monies. However, under this program, this would require a full funding of the term loan. And like I mentioned before, the meter is running. So you would have the full debt carry at 100% rather in a traditional construction loan where there's borrowing ups and you're only paying interest on the amount funded.
Oh, okay.
I think you kind of covered it there. So again, there's not a restriction on if a construction company can get it, but to Derek's point, some good things to consider there from an interest perspective.
Okay, excellent. So this is a more specific question, probably for Derek. When it comes to the Main Street priority loan, does your PPP loan need to be subtracted as outstanding debt from our Main Street loan? My understanding is that it's 6 times EBITDA less outstanding debt up to 50 million.
Yes, if it's unforgiven at this point, extending the forgiveness period out to 24 weeks and with the rollout of this program now crossover. So the best way to kind of gauge where you would fit into the amount of what you can borrow under the Main Street which would to take your 2019 EBITDA, multiply it by the amount of leverage under which program you're going to do, and then deduct from there any loans that will not be refinanced through the proceeds of the Main Street loan. And then you arrive at the amount of the Main Street loan.
Okay, thank you. I think this question is for Samira. Can a nonprofit apply for the loan, and nonprofits including other organizations such as hospitals and universities as well?
Yeah, so I did not go into that term sheet yet, so I'll take a moment to tell you a little bit about the nonprofit window that we have created. I imagine some of you may be actually from large nonprofits or on the boards of nonprofits who could qualify. The underlying idea here is really similar to the business loan. We're trying to get loans to small and medium-sized nonprofits that were financially sound before the pandemic, but could use a cash infusion to manage through these difficult times. In this case, we only have 2 facilities. It's a new loan facility and an expanded loan facility. The general terms are going to be mostly the same as the other Main Street one. So it's 5-year loans, interest payments deferred for 1 year, principal payments deferred for 2 years. Interest rate range is the same. The amortization schedule is the same. But we had to obviously tailor the eligibility requirements to nonprofits instead of businesses. So what we have here to qualify is you've operated continuously since 2015 or earlier. You have at least 10 employees, but no more than 15,000. Your 2019 revenues were 5 billion or less, and your endowment was under $3 billion. And then a total non-donation revenue of equal to or greater than 60% of expenses in 2017, 2018, 2019. There's additional requirements in the term sheet on like liquidity and leverage, but I won't go into those nuances. And for the nonprofit new loan facility, it's going to be that same minimum of $250,000, and the maximum is going to be the lesser of $35 million or the borrower's average 2019 quarterly revenue. So we're using quarterly revenue there, not EBITDA. And then the expanded loan facility for nonprofits, the minimum loan size is 10 million and the maximum is a lesser of 300 million or the borrower's average 2019 quarterly revenue. To get a Main Street expansion loan, a nonprofit's original underlying loan must have been made on June 15th or earlier. That's a little bit later than the expansion program for businesses because this program is being rolled out, was rolled out a little bit later. We still have this one, this term sheet is very, very new. So I know we're still receiving comments on it. Officially, the public comment period is closed, but definitely welcome questions and comments additionally on how this one can be improved.
Okay, thank you. Couple of questions regarding personal guarantees. Are personal guarantees required?
That will vary from lender to lender.
Okay. And I also, a few people are asking whether or not there's an authorized list of banks. I believe you provided a link to the Boston Fed that has a list, but that doesn't mean that it's all exhaustive, right?
Exactly. Not exhaustive, but that gives you some sense of lenders who are especially accepting new customers.
Okay. If somebody is currently in bankruptcy proceedings, are they able to apply for the loan?
I think we covered that. So no, if you anticipate being in bankruptcy or currently in bankruptcy, you cannot apply for the loan.
Okay. Someone's asking if this is strictly for Miami-Dade County, and the answer to that is no. Obviously, this is a statewide program, a countrywide program. Someone is asking a specific question. We had robust discussion with the PPP loans regarding foreign ownership. It appears that as long as the formation and operations of the business is in the U.S., foreign ownership won't disqualify the borrower from applying. Am I correct?
That is correct. Yes. So it's something we should probably talk about for another second, because being that we're in Miami, there's a lot of international businesses, and we've had many ask that, can a U.S. company that's a subsidiary of a foreign company qualify as an eligible borrower? And you can, again, as long as you were created in the U.S. and your significant operations are in the U.S. along with your employees, and you don't use that money to distribute to your foreign parent. As long as the money is for the benefit of your domestic company, you can apply for the loan. And again, very similar to the provisions of the PPP loan program. So if you qualified for that, there's a good chance you're going to qualify for Main Street or be eligible to apply.
Okay. To what degree does the 5% risk retention disincentivize lenders, Derek?
I don't know. I think that could be best construed as, unlike the PPP, where you had the forgiveness and the fallback component of the 100% guarantee, that the lender, although remaining 5% in the deal, can be considered as having 100% of its 5% stake in any one transaction under the MSLP.
Okay. Someone else is asking, I'm sorry, can you speak about franchise restaurants and company-owned restaurants which don't have headquarters in Miami-Dade? What are they eligible for? I don't think it matters whether they're Miami-Dade County, so do you have any information regarding franchise restaurants and company-owned restaurants?
The eligible businesses runs parallel with an SBA program. The SBA has certain eligible franchise types, and so long as it's eligible under the SBA, it should be eligible under the Main Street.
Okay. Can real estate investors benefit from this program? By this, I mean companies that own and manage income-producing properties such as shopping centers or multifamily properties.
You want to take that one, Jordan?
It
The answer to
depends.
that question, yeah.
There is some limitations on passive investment companies, including certain passive real estate. So, it's something I recommend depending on the nature of exactly what they do to consult with, their legal or their bank or, their advisors on their specific eligibility.
One thing I will add to that, though, is that leverage in the real estate world and leverage from a operational cash flow perspective don't necessarily mix together. So with the repayment terms structured as they are under the MSLP, that might be overly burdensome relative to the existing debt or the repayment terms of whatever debt facility any one real estate investor may have on their particular property.
Okay, thank you. Someone's asking, why are so few banks participating? And is there any consideration to potentially offer more consistent repayment terms or a longer amortization for the back end of the loan?
I think the program is evolving and we're not looking at the final version of what it stands to be over in the long run, even though there are only about 60 days to originate credits between now and the current expiration.
And I think
Yeah, I
lenders
think
are
we saw with the
continuing,
PPP.
lenders are also continuing to register. So it's just an ongoing process on our side for that.
Yes, I think I've heard from many lenders that they're still reviewing the program and looking to see whether it fits their clients' needs. So I think that you should keep checking with your bank if they haven't started participating yet. They might.
I'll add there, we really encourage lenders to consider looking at these terms, signing up and registering to be a lender, even if you're not sure if you're going to actually offer the loans yet, just so you can get through the registration process and then begin to work through whether these loans make sense for you or your clients.
Understood. Someone's asking if we can define debt. Do you add long-term lease obligations as debt? My question specifically is for a long-term ground lease obligation. Derek, would you know that, or Jordan?
That may fall under the definition of adjusted EBITDA and the determination that is consistent with the bank's underwriting and calculation of leverage. So if the bank or lender is currently calculating total overall leverage that factors in capital lease obligations as the numerator, if you will, and a debt and an obligation, then the answer to that question is yes.
Okay. Also, I've had a couple of questions regarding whether or not someone has an SBA EIDL loan and whether or not that has to be paid off before applying for this one.
I believe the terms of those are unsecured 30-year loans. They would be factored into the total amount of borrowing under the MSLP. It's not required that they are paid off as an unsecured creditor. You just need to make sure that the loan is, the MSLP loan would be in a senior position or at least pari passu with that loan as an unsecured transaction.
Okay. Someone is also asking whether a nonprofit can use the loans to pay off outstanding real estate mortgages.
I can follow up with you as a response to that question. So I've asked the team here to write down questions for me that I can follow up with them right now.
Okay. So I'm sorry, so you're not able to answer that right now?
Yeah, I'll follow up.
I apologize. Okay, sure. Is there any case where a shareholder loan balance in a sub-S corporation can be excluded from the total leverage formula when determining loan size? Does anybody have an answer to that?
I don't know the specific answer to that. I mean, a related party debt, I'm not sure how the banks are going to look at that. I mean, obviously, it's going to be subordinated debt to the Main Street facility. I just don't know how, if at all, that'll be calculated for the loan purposes, because that, you know, that debt could easily be equity too. So I'm not sure, Derek, if you've seen that yet, or.
I have not seen it yet. I think that some of the early consensus is that as it's subordinated and convertible to equity, that it doesn't necessarily factor into the equation. But again, I'm going to resonate the same response that it may vary from lender to lender.
And I think that's going to be true for a lot of the questions. Each lender will have their own underwriting criteria that they're going to use. Okay, what types? Let's see, total debt. What years do you have? I think you covered this, but just in case, let's repeat it. What years do you have to pay interest on the loan? Year 1, year 2, and year 3?
In all years 2 through 5. However, the interest is accruing, although not obligated to be paid during year 1.
Okay, so the interest will accrue, but it's not due until year 2, 3, and 4, you said?
Commencing with year 2 through 5, yes. Interest is due and payable monthly from that point forward.
Okay.
And then principal would start on year 3.
Correct.
Okay, yeah, someone did ask, the first payment on principal is on the 36th month after the loan is issued, correct? And I think that's
correct. Yes, and that is 15% of the then outstanding balance.
Someone is asking whether the loan criteria is based on an owner's credit report scores or granted based on the company credit score.
It's not a determination of eligibility. However, it will be factored into the ultimate credit decision.
Okay. Here's a good question for you, Derek. How would the bank know to determine whether or not the borrower is able to make the 70% payoff? How would you determine that?
It would be subjective, it'd be based on the assessment of the company's historical performance overall and its ability to rebound back post-pandemic to normalized operations. And like I mentioned before, financial projections would assist the bank in making that determination.
Okay.
I think, yeah, what's important to highlight that the purpose of this program was not to help companies that were in a bad place before COVID-19. It's really, you know, it was meant to help companies that were good businesses, healthy businesses prior to COVID-19. And because of COVID, they're in a situation now where, you know, they need some assistance. It's not, you know, you were a distressed company in December of last year, and now you're going to come apply for this. It's not intended for those types of businesses.
Okay, understood. Here's another specific question. Can a startup internet consumer products business who is preparing to launch and has invested over $1 million in product development and only generated less than $10,000 in revenue? I think this is a very specific question. I'm not sure if you'd be able to answer it, but less than $10,000 in revenue made from small test cycle. So I guess they're wondering if they would qualify for the loan.
Nothing's prohibiting them from applying, so I would search multiple lenders to see if there's an appetite for that.
Okay. Someone is asking you personally, Derek, whether or not, you know, what kinds of deals you're looking at, or what, you know, what kinds of transactions your clients are coming to you with. Are you able to share some examples?
I'd rather not share. I can share that they did span the contiguous 48 states from coast to coast in all corners of the U.S. Anywhere from tech companies, hotel-based or airline-related industries, private equity firms, several brokers. So I can't really nail it down to any one specific type, but you know, we are out there and taking a look at a lot of different potential loans to pursue. And I think Lucy or somebody else there can share our inquiry email address. It's mslp@pnb.com. And if you have any specific inquiry, then you can contact us there.
Okay, thank you. I think we can share that on the chat, in the chat box, so that everyone will have that. If you have an emergency SBA loan, do you qualify for the Main Street loans?
Not necessarily, no. You have to qualify under any particular bank's underwriting standard. as set by each individual lender.
Okay, I had a couple of people asking what type of documentation is needed from the business in order to qualify, in order to apply for the loan. Can you do a brief overview on that?
Yeah, I'll just cover exactly. It's going to vary from lender to lender, as I mentioned, but a good start is to grab at least 3 to 5 years of the performance of the business. So tax returns, your compiled CPA statements, reviewed, audited. The higher on the quality spectrum, the better. If the lender will require personal guarantees, get updated personal financial statements for each individual, as well as 3 years personal tax returns, 1040s of theirs.
Okay, maximum in term of years to repay the loan, maximum term to repay the loan.
5. It's non-negotiable. The interest rate, the fee structure, the term of the loan, and the repayment are all specified and cannot be altered from the term sheet that are issued by the Fed.
Yeah, I think one of the biggest questions there is people's concern is, okay, what happens in year 5? You have this huge balloon payment of 70% of loan principal. And, you know, right now under the specific program, there hasn't been any, you know, clarity on that point. Obviously, you know, you can try to refinance the loan under conventional programs when the term's coming up. But as of right now, year 5 is, you know, the end of 5 years is when this program loan would be due.
Okay, I do have a question. We do, according to this person who's asking the question, this participant, we do comply with all the requirements, and we have contacted all the banks listed on the MSLP website for Florida. Some of them do not serve the Miami area. Some others consider our required amount too small. 3 to 5 million is what he put in parentheses. And for the few, just 2 that are okay with the amount, they required a fully collateralized amount. Seems like this program is just for those either big or with money. Isn't this program intended to help small and medium companies needing the financial support?
I think that has a lot to do with the risk appetite of any one lending institution. I think we all can agree that these are unprecedented and uncertain times. So any decision made by any lending institution has to take in the full gamut of the future outlook of the economy and the business operation and how well it's performed over a history or a time horizon. So it's kind of hard to nail that down necessarily to how any one lender will interpret any one credit.
That feedback's really helpful for me to hear, and for those of you who know our staff in the Miami area, you should always feel free to offer them that kind of insight, because we are often able to bubble that up and share that internally, so that, because the intention of this program is to reach to credits like that. And as Derek said, these are really unprecedented times, and these are really new programs. And so we're listening deeply to people's experiences and trying to learn and figure out things as well on our side.
Thank you. So what is the interest rate and fees associated with this loan? Derek or Jordan, who knows?
The interest rate's at LIBOR plus 3%. So it's variable, you know, based on the LIBOR rate plus 3. As far as the loan fees, I believe it's approximately 2%, and it can vary a little bit bank to bank, but I'll let Derek chime in on that.
Yeah, so there are 2 percentage point fees that are detailed in the term sheets. One is an origination fee due to the bank, and the other is a 1 percentage point that is paid to the Fed's SPV. There is some flexibility with the 1 percentage point paid to the SPV as to whether or not it is borne by the bank or the borrower.
Okay, and I think I read that there were also some legal fees that may be involved.
Yeah, your standard documentation fees from counsel, those would be standard in any loan closing transaction.
Okay, understood. Someone is asking, isn't LIBOR going away? And we did talk about that.
The answer to that is yes, and I believe it was addressed in a lot of the Q&As with the Fed and the webinars that were put out. I think they're just going to See what happens.
Okay, are new appraisals required before closing?
It'll be a lender-to-lender requirement, but I would probably say it's safe to assume the answer to that question is yes.
Okay, I have another question regarding debt. To confirm, does total debt include other liabilities such as account payables and other accruals? Or is total debt based only on senior debt? Total debt is defined as the following below in the FAQs. Total debt, including undrawn available lines of credit, equals existing outstanding and committed debt, including any undrawn available amounts. So does this mean that it includes liabilities such as accounts payable and other accruals?
Normally, those don't meet the definition of debt, accounts payable and other accruals. What they've gone out of their way to mention here is if you do have a revolving line of credit, let's say, a $5 million line allows you to borrow up to $5 million, but you've only borrowed one. Well, they're going to consider the entire $5 million as, drawn debt for purposes of calculating how much you're eligible for under the Main Street program.
Okay, thank you. So if you need 100% collateral and the U.S. government is guaranteeing the loan at 95%, what's the benefit for the small and medium-sized companies when there is a double collateral? He considers the fact that there's a guarantee and there's also a collateral.
Let's be clear. It's not a guarantee. It's just a share in income and losses. So in order to protect the loan, it's protecting both the position of the SPV and the bank simultaneously.
Okay, thank you for that clarification. Is the Fed's participation voided if there is any default during the life of the loan? Does anybody know that?
I can follow up after checking with folks internally on that one.
Okay, thank you. So just a general question. What's the difference between this loan and a regular commercial loan? If a small business were to apply to you, Derek, for a regular loan under the same types of terms, what's different between this loan and a regular commercial loan that you would do on a regular basis, a conventional loan?
Gotcha. Yeah, the limitations specified and the borrower certifications is the predominant difference. Normal lending covenants and conditions wouldn't necessarily prohibit a lot of what the certifications are restricting any one business to do. Other than that, there is no real difference other than not having negotiable terms and fees and whatnot. Loan participations happen every day across commercial lending. Some borrowers may know or not know. For the most part, it's a means by which certain lenders can lend above what their legal capacity to do so is. So they'll bring in another bank and offload some of that exposure. So it's for the most part pretty standard, with the exception of the repayment terms, fees, and everything that cannot be negotiated.
Okay.
What
and just to chime in,
add there is that, like, from our perspective, just to expand on what Derek said, we think that it can create additional balance sheet capacity for lenders if they need to extend more loans because of that participation structure.
Okay.
Yeah, the idea behind this program, I think, in comparison to like a normal loan, is to draw attractiveness to the lenders. I mean, the Federal Reserve is offered to, participate in 95% of the losses, which, in theory, it should incentivize banks to otherwise participate in a loan that maybe they normally wouldn't, because of that, backstop. Obviously, there's just been a lot of hesitation, I think, from the entire economy for banks to jump into this, but you're seeing more and more starting to participate. Again, just like PPP, there was 20 changes to the program since its inception. I think we're starting to see the evolution. I mean, the frequently asked questions on this went from 15 pages to 80 pages in the span of a month and a half. So it is evolving and continuing to, and I think, the idea again is incentivize banks to want to lend to companies, and in a 6 times EBITDA calculation too, is normally amounts that you may not normally qualify for. But again, it's all in the hands of the bank and, whether they're going to approve you for it. So
Yeah, and I would add to that, you know, it's these programs were designed, and the crisis has evolved day by day and week by week as we're all experiencing it, right? Foremost is a public health crisis, and how well we contain the spread of the virus will dictate the pace and timing of economic recovery. You know, Alfred had that great mask up front to remind us of all of our responsibilities there, but you know, remember, there was a resurgence of economic activity in May and early June as businesses began to open. But now we at the Fed are starting to hear more and more people concerned that the recovery might be losing steam as you see a rising number of COVID cases. So remember, the state of the economy is going to interact with these programs and the attractiveness of these programs to the borrowers and the
Sure. Obviously, this is just giving us another tool that's available, and some businesses may not qualify for this, or it may not be, you know, they may not fit in that box. But it's basically just another tool, just like the PPP and other loan programs that the government has come out with. So we appreciate that, Samira. Okay, I think that we're done with the questions, unless anybody has any other questions. As everything that's in the Q&A and I believe in the chat has been addressed. If anyone from staff has anything else that I haven't addressed, please let me know. Otherwise, I think that everybody would appreciate that we end early today. So I'd like to introduce Lucy Nunez, who is a Senior Vice President with Pacific National Bank, and she's the co-chair of the Banking and Finance Committee. And she will end our session with some closing remarks.
Thank you, Irby. And I really just want to take this opportunity to thank everybody for participating in today's session. I want to take the opportunity to thank each one of our panelists. This was a preparation, and just trying to make sure that we get as much information as possible to all the committee members from the Banking and Finance, the chamber members, and all of the invites. So thank you, Derek. I'm proud to say he's my coworker at Pacific National Bank. I really appreciate you sharing all your expertise and all your studies in this program with the rest of us. Samir and Jordan, thank you very much for your expertise and helping us bring another aspect besides the banking side to this. And Irby, you are our fabulous moderator. We really appreciate all your help. Thank you. Thank you to the chamber staff for helping us with this remote Zoom session that I believe has been a great success. I look at the number of participants that are over 100 participants on the call. It's great to be able to reach this number of participants. So thank you very, very much, chamber staff, for all your help in coordinating this. I'm very proud to be the co-chair for the Banking and Finance Committee, along with Gladys Reed, and who opened up the session. And I just want to welcome you all to our committee. If you are not a member, please join, and please join the chamber. And if you're not a current member, we would like for you to go to our website. There are tons of events with very relevant information just as this that would love for you to join us and help you grow and answer your questions and help expand into your business and your network. So with that, I really just want to once again thank our sponsor, MBAF. Thanks everybody for your involvement, and wish everybody a good afternoon. Thank you.
Thank you.